Welcome, this is Accounting with Bennett Tchaikovsky. Our topic today is inventory transactions, and we will be doing this from the seller's perspective. This presentation is copyright 2008 to 2018 by Bennett Tchaikovsky. All rights are reserved. So the way I love to teach accounting is through problems, and because when I teach through problems, it's that much more entertaining. And it's a little bit more practical. So we have this question here, which is the dogs, cats, who sold 500 packages of food to Kittens Puppies Inc. Packages are sold for $50 each and cost DCI $20 each. The packages were sold on October 1st, FOB Destination, and the terms were $210 net 30. So when we're dealing with inventory sales, unlike our services revenue or when we were performing services, as we looked at in the earlier chapters, what is different about inventory sales is I essentially have two parts of a transaction that are happening. And the way I kind of like to look at this is if I'm heading into a Costco and I'm going to be paying for my goods, what Costco does is Costco will show accounts receivable and then sales revenue. And this is no different than what we were doing before when we had services revenue. And the reason being is because I'm selling something. However, the difference is I'm selling inventory. So the first part of the transaction to actually go through and record the sale is not really changing. We're debiting accounts receivable. Accounts receivable is an asset. That customer owes us money. And we're crediting our revenue, which is in line with the way we've been learning accounting previously. So when we go through and record the sales revenue, we're going to be showing how much. Well, I sold it to KPI. I sold 500 packages at $50 each for a total of $25,000. So that's where I'm getting that first number from. And then I'm also debiting accounts receivable for the same amount. What else is happening on this day? Well, I'm having inventory. I'm having inventory leave my books. And so why is that? Well, if I'm purchasing something from Costco and we have that first part above showing the amount of the sale and debit to cash, credit to revenue. The other thing that's happening when I'm leaving Costco is that the customer is taking the inventory with them. So what I need to do is to take that inventory off of my books. And so here, the inventory is an asset. So I'm going to show a decrease to that asset with a credit. Now note here, it tells us that the packages were sold for $50 each and cost us $20 each. So I'm going to have 500 packages, and those packages cost me $20 each for a total of $10,000. So I'm just realizing right now this should be 500 at 50. I usually have students with me to yell at me when I've made mistakes, so I'll have to make my own corrections today. So we have 500 packages at $20 each. That's what the inventory cost us. So in this part right here, when we go look at LIFO, FIFO, weighted average, periodic, and perpetual, those are different ways of coming up with this dollar amount here in terms of assigning it to what we call cost of goods sold. And right here we've got what we call COGS. And we're going to go ahead and debit cost of goods sold for $10,000. What is cost of goods sold? Cost of goods sold is really for a retailer is what did the merchandise that we sold, what did that actually cost what did it actually cost the company? And we'll get to a income statement shortly, but again, the cost of goods sold is really here an expense of selling that, what we're going to call an expense of selling that inventory. The inventory is no longer on my books because I have sold it. And so here I have to go through and show this here as a credit. Now, when it comes to the journal entry, if I've gone through and if I have done my work correctly, I have here accounts receivable with a debit of $25,000, sales revenue with a credit of $25,000. Notice very carefully here, what I am doing is I am indenting the descriptions, debiting accounts receivable, crediting sales revenue. Why am I indenting sales revenue here? Because I have to indent my credits. I realize that on computer programs such as QuickBooks, they don't do it, but not for my class. So here we're debiting cost of goods sold to show the cost of that inventory leaving my store, and I'm crediting inventory for $10,000. And this, my description would be to record sale to, what we call this company, to KPI, Kittens Puppies. So record sale to KPI. Now remember, for the journal entry description, what we put here is really going to be dependent upon your supervisor. I'm your supervisor for today, so this is the way I would want to do it. Okay, now what date should I go through and record the sale? And this is where we get into some of the terms down below, but this is where the terms become very important. So the first term here is it's said it's being sold FOB Destination. What does FOB mean? So as all of you are giggling and as you're now understanding why I will never ask a student again during class session what that means, this means free on board. What this refers to is when does title transfer to the buyer? When do I record the sale? So FOB shipping point indicates that title transfers as soon as the goods leave the seller's place of business. So that is FOB shipping point. If this transaction were to have been FOB shipping point, the moment that they left the warehouse, what we would do is we would say here, and I'll give this a little bit extra. The moment that they left the warehouse, we would be going over here and saying, oh, they were shipped on October 1st. This is only if it was being sold FOB shipping point. However, what we have here is not FOB shipping point, but rather FOB destination, which means that title transfers when the goods arrive at the buyer's place of business. What this is really here to talk about is who is responsible for the particular goods. And there is no one correct way to go through and do this. It's going to be depending upon the contract that the buyer and seller are signing. And that can be a verbal contract. There's a lot of different ways to have a contract, better to be written. However, very important. What free on board tells us is when do we record the transactions. So as this was being done, FOB Destination, and Kittens Puppies received the packages on October 4th. Right here, I'm going to record the sales transaction as of October 4th, 2018. So that's, again, a very important concept as we are going through and looking at how do we and when do we go through and record sales. So that's October 1st. Now, what is very important to remember is if I have a sale of goods, this form of journal entry, meaning I am debiting accounts receivable, crediting sales revenue, debiting cost of goods sold, and crediting inventory will never change. If I am a merchandiser selling inventory, this form of journal entry will never change. Is this a good thing to memorize? Absolutely yes. Very, very important. Now, the one thing that will change is the date, because if it's FOB shipping point, we record it at the date of shipped. If it is FOB destination, we record the transaction when it arrives at the buyer's place of business. So let's get to the next one. So on October 5th, Kittens Puppies returns 100 packages for full credit. Now we're getting into something a little bit different here. This is once we make the sale, what can happen as soon as we're going through and after we make the sale. So to look at this, let's kind of think this through and go back to our original transaction. So here, there is a physical return of goods by the buyer. So if I'm the seller, I'm going to be receiving back inventory. I will just use the existing account. I'm getting back inventory from the buyer. And how much am I getting back? Well, on October 5th, it was 100 packages. So the cost of that inventory to me was right here, or 100 times 20. And this is on October 5th. So that sounds right. So 100 packages times 20. Oh, there we go. So 100 packages at $20 each are being returned. And so this is where I'm getting this part from here. So I'm debiting inventory. Now at the same time, right over here, I need to be crediting cost of goods sold for the same amount. And why is that? Well, my cost of goods sold really related to the sale of this $25,000 worth of goods. However, since inventory is returning to me, I need to be showing this as a reduction to my cost of goods sold. Very important. We're using one inventory T account. In reality, if we receive goods back from a customer, we have to go through and highlight that separately. Why do we have to highlight that separately? Because often we can never again sell that as new. It has to be sold as refurbished. If you're looking for a great discount, take a look at like www.woot.com. It is a website that is owned by Amazon. If you look through their electronics and other items, you'll notice that there are a lot of things called factory refurbished. And so therefore, in reality, we would probably be using a different inventory account, possibly a debit to returned inventory. But however here, we're just going to debit the inventory account. Now, that's part of it to show the goods coming back. And at the same time, is this customer still owe me $25,000? The answer to that is absolutely not. So the customer no longer owes me $25,000. They owe me $25,000 less these 100 packages. And here, the 100 packages times the price of $50 each, or over here is going to be 5,000. And this was also on October 5th. So here, my customer is returning $5,000 to me. They no longer owe me $25,000. Once they return the items, that's what happens. And remember, in real life, before we return anything, we need to make sure that we clear it with the seller that we are returning goods. Very, very important. So normally, I would say, hey, I need to go through here and debit sales revenue, but we don't do that. We don't touch revenue. We leave revenue alone. But instead, we're going to use what we call a Contra revenue account. And this is going to be called sales returns. And this here is going to be for a debit of 5,000. And let's make the little colorful rainbow for this one particular journal entry. My students love me for this. And here we go. They hate me for many other things, but they like me for this. I can make a coloring book. It's really fun. Okay, so I'm going to debit sales returns, and this is what is called a Contra revenue account. And why is it something we call a Contra revenue account? It has a debit balance. Here, sales revenue has a credit balance. This here has a debit balance. So that's what we're doing here. Okay. Next item up for bids. So I now need to go through here and do a journal entry. So the sales return happened on October 5th. So here I debited sales returns for 5,000. I credited accounts receivable for 5,000. I debited inventory for 2,000, and I credited cost of goods sold, or COGS, for 2,000. And I will highlight these in that off yellow so that you can see where I went through and added them in. Okay. The other part of this is similar to what we were looking at before, is if I ever have a sales return, the form of journal entry that I'm going to be using is going to be this highlighted in blue. It never changes. And this form of journal entry never changes. I debit sales returns. I credit accounts receivable, I debit inventory, and I credit cost of goods sold. So this part here never, ever changes. Very, very important. So let's now go down to our next transaction. Our next transaction was DCI gives KPI a $2,000 sales allowance. What is a sales allowance? A sales allowance is when the seller says, hey, you're a great customer for whatever reason, what it might be. I'm going to take $2,000 or whatever that is off the amount that you owe me. A great example of this is a while back, I bought a computer from Dell. When I purchased the computer from Dell, I decided I did not want it anymore. So before I returned it to Dell, I had to call them up and get a permission to return. And so I was on the phone with Dell and they said, hey, Tchaikovsky, would you like to keep this computer? We will give you a $1.6 billion lottery jackpot and never see you again. I'm just kidding. In this one right here, they said, hey, would you like to keep the computer and we'll take $250 off your bill? And I said, no, thanks. Why do companies want you to keep the inventory? Because of this. When a company and when a customer has to return something, the seller can no longer sell it as new. So oftentimes they're going to figure out a way. It's like, well, if I give you this discount, what will you do? So again, much like Woot, those items that are actually returned end up getting sold. Now, some sellers, such as Tesla, would never want to give you a sales allowance. And why is that? Well, if something was wrong with their car, they're going to want to have it come back in and go through and check it out. So what does sales allowance mean? Well, if I'm giving a sales allowance right here, I'm going to know my client will no longer owe me $2,000. So here, what I'm effectively doing is saying to my customer is that, yeah, you no longer have to pay me this $2,000. So and why is it I'm crediting accounts receivable? Because the customer no longer owes this to me. So I'm crediting accounts receivable. I need a debit. What do I want to debit? The account that I'm going to go through and debit is going to be what we call sales allowances. And this is what we call a contra revenue account right here for $2,000. So I'm crediting accounts receivable because the customer no longer owes me that. A sales allowance means I'm telling them, hey, you've been a great customer for whatever other reason. Here's an amount less that you owe me. And so here I'm going to be debiting sales allowance, which is all sales allowances, which is always a contra revenue account, which is also a contra revenue account. So now I come over here to record my transaction. And this was on October 8th. My date here is October 8th, 2018. I am debiting sales allowances for $2,000. And I am crediting accounts receivable for $2,000. And this is going to be to record, let's say, to record sales allowance given to KPI. And in reality, I would probably come up with some more things here just to kind of say, oh, why was it given? You know, just so I can have a better understanding in terms of what that is. So right here, I have a total amount here of 2,000. And why I'm highlighting this in blue is because when we're giving a sales allowance, this form of journal entry will never change. It is always going to be a debit to sales allowances or sales allowance and a credit to accounts receivable. Notice sometimes you will see companies combine these. They'll say sales returns and sales allowances, which is fine. I like to separate them out here in terms of teaching because they both have different definitions. But the journal entry form that we're going to be going through and using to record a sales allowance will never go through and change. So that's what happens on October 8th. Now on October 10th, KPI pays the outstanding balance, taking advantage of any available discounts. What exactly does that mean? When we go back and look at the initial question, we see the packages were sold on October 1st, FOB Destination, and terms were 210 net 30. What does that mean? Well, when I see 210, this means if the customer pays within 10 days, customer is entitled to take a 2% discount off of the amount due. And what this essentially means, well, if I owe $18,000 or 25 less 15 and 2, I can take a 2% discount as long as I'm paying within 10 days. Now, many of you might be saying, Tchaikovsky, does that mean 10 business days? Does that mean 10 days from the date that KPI received it? What does that mean? In this example here, I am using straight up from October 1st if they're paying within 10 business days. In reality, what we'll say when the discount happens is going to be the contract. So the contract will essentially go through and dictate how that ends up being recorded. So let's go here and take a look at the rest of this. So 210, if the customer pays within 10 days, they're entitled to take a 2% discount off the amount. What does N30 mean? This is net 30, or the full amount needs to be paid in 30 days. Now, from my prior videos regarding accounts receivable, very, very important, before I extend credit, I need to make sure that I'm going to get my money back from Sears, from Toys R Us, from other various retailers. Sam's a little bit too dark Tchaikovsky, because it is. And we really need to be careful about who we are selling to. Now, if I gave you a term such as 315, what does that mean? Well, what 315 means 315, if the customer pays within 15 days, the customer is entitled to take a 3% discount off the amount due. And remember, this is very important for some businesses. Cash is king, and you want to get paid as quickly as possible. There is a formula by which you can go through and determine the amount of what they call the purchase discount lost, meaning that what happens if I don't take this 2%? Is it Carmageddon? Is it Sharknado? Armageddon? What's going to happen? Dogs and cats living together in mass hysteria. Thank you, Bill Murray. What all this means is that if there is a lost interest rate when you compound this throughout the year, and it ends up being something, if it's a 2%, 10, it's around 30% for the year, which is great. However, I want to caution you, if you pay quickly and you don't, and you're waiting from cash from somebody else, getting money from a lender is very, very hard to do. Cash is king for almost every single business. So we have to be very, very careful in terms of before going through and making early payments. So with that being said, we're now at October 10th. So KPI is paying the outstanding balance, taking advantage of any available discounts. So is KPI paying within 10 business days? The answer is yes. We bought it on October 1st. It's now on October 10th. That is within 10 business days. So how much does KPI owe me? Well, KPI right now owes a total of they owe me 25, and then they returned items for 5, and I gave them a $2,000 discount. So the amount that KPI owes me as of right now is going to be $18,000. So I'm right now owed $18,000 by KPI. However, will KPI pay me 18 grand? The answer to that is no. Why not? And the reason is they're paying within 10 business days. So the actual amount of the cash I'm going to receive is not going to be $18,000. The cash I'm going to receive is going to be so my total discount here is going to be $360. So the amount of cash that will be received from this transaction is going to be my accounts receivable of 18,000 minus the discount of 360 cash received will be $17,640. So that's what's happening here. The amount of cash I receive from this will be $17,640. So how do I put this into T accounts? Well, the cash that I receive, we're going to put right here. I'm getting cash on 10/10 of $17,640. At the same time, does this client still owe me $18,000? And the answer to that is no. Why not? They're paying within the discount period. So here on 10/10, I'm going to need to show this amount fully coming off my books. So as we look here, we've got an $18,000 credit to accounts receivable, and I have a $17,000 $640 credit to cash. So I'm out of balance. I have $17,640 in debits. I have $18,000 in credits. So I need another debit here for $360. And that $360 represents the amount of the sales discounts. And this is, again, a contra revenue. This is a contra revenue account. And this is telling us the amount of the sales discounts that we had given for this particular client or for this particular customer. And so here we have, so I've got 18,000 in credits to accounts receivable, 17,640 in debits, 360 in sales discounts. Remember, once this customer pays me, even if it's on time, they now owe me nothing. And why? I promised them that if they paid within 10 business days, they would get a discount. So if you put in 17,640 and you still showed a receivable of 360, that would be incorrect. So let's go over here and do the journal entry. So it's 10/10/18. Here I received cash for $17,640. I had a debit to sales discounts of $360. Uh-oh, my students again would be yelling at me. Sales discounts of $360. Yikes, I'm losing it today, too much coffee. $360, and then I'm debiting accounts receivable for $18,000. And here is to record receipt of payment from KPI. So right here, what I have essentially gone through and done is that this is my journal entry to show the cash coming in if a customer is paying within the discount period. Again, why am I highlighting this in blue for the moment? Because this form of journal entry will never, ever change. Very, very important. This never, ever changes. I'm debiting cash, debiting sales discounts, and I'm crediting accounts receivable. This form of journal entry never, ever changes, so you can memorize it. You know, memorize it, don't criticize it, right? We're a little tosh for the morning. Okay, let's go back here. I don't think it was actually Peter Tosh. Oh, it could have been. Anyways, and then it was Jimmy Cliff. I'm getting my reggae wrong. Let's go ahead. And the next thing I want to do is just take a look really quickly at what does our income statement look like from all of these transactions, and what the income, or like at least at the top part of the income statement. Now, before, when I had, let's see, DCI, and just kind of looking at this 1 month, if DCI only had one transaction, what would their income statement look like? Well, their income statement would essentially have sales revenue of $25,000. Now, when we look at these other items down here, meaning our contra revenue accounts, here minus sales returns, minus sales allowances, minus sales discounts. And why am I subtracting these from revenue? Because these are all what we call contra revenue accounts. And therefore, what I need to do is subtract these, each one of these items, before what I get to my net sales. Very important. And when I subtract these through, my net sales revenue, and why do I call it net? Because it is net of any type of sales returns, allowances, or discounts. And I have my net sales revenue here. I then subtract my cost of goods sold, my ending cost of goods sold. Needed to add these up. I had one adjustment here. My ending cost of goods sold was 8,000, or 10,000 minus 2,000. So my gross profit is going to be, meaning what did I make from my inventory sales, is going to be 9,640. Now I know that my journal, my financial statement formatting is horrible. Do not follow this format. Follow whatever your instructor wants you to do. But right here, this is a very important concept. For the user, and remember, who are we making our financial statements for? It is for the investor. To give the investor the best possible information so they can make a decision, I don't really want to tweak or change sales revenue once I record it. I need to show here sales returns, allowances, and discounts. The reason why is that what if, say I had $100 million of sales revenue, say 100 million of sales revenue, and I just gave a sales allowance of $1,000. Doesn't really matter. But what if I had $100 million of sales revenue and I gave a sales allowance of $75 million? Then to a user or to a reader of these financial statements, they say, wait a second, you're showing, and I'll just kind of borrow from this up here to illustrate the point. If I had sales revenue you got 100 million, right? So say if I had sales allowances of negative 75 million, and my cost of goods sold, we'll say would be 10 million. Just again, we're making this up. And this number now, it's not really a small amount. This is a very large dollar amount. And so I have to show the user of my financial statements, and this again is who I'm making this for. I need to show them, hey, that these allowances are very significant. And when you're going through and looking at disclosure, you have to remember that would this make a material difference to an investor, meaning would this influence potentially an investor's decision? And if I said here, well, the sales allowance is almost 75% of total sales. Now, as opposed to say something along the lines of, well, whatever was $7,500, then here it really becomes immaterial because it's a fraction of a cent. So that's something really to try to remember as you are going through and looking at this in terms of how we show our investors, why we do it. Why do we use contra revenues? Because if there is a significant amount of returns or allowances or discounts, we can't just take this off sales revenue and bury it. We need to get it out there. Also, too, when I'm commissioning salespeople, might be running into a problem where if a salesperson is being commissioned on gross sales, they're not really going to care about allowances or returns. They just want their money. They just want to make the sale, and they're not going to really care about what happens after that. So again, it's very important to remember as we're looking at this question in particular, how we disclose it is really going to be depending upon, the material nature of it. But what I really want you to come away from this is we use these contra revenue accounts for a very important reason, is to show the users that here was revenue, here's where the returns, allowances, and discounts given on those particular sales. So with that being said, thank you for another intriguing, and thank you for listening. I'm not going to say punch the like button because I don't think these are yet public, but I will see you soon. Take care.